Greetings, financial literacy family. Today, we're on a journey to unveil a compelling financial strategy that could amplify your market returns, dating from 1960 to 2020. Imagine elevating a $100,000 investment to an astonishing $5 million. Let's unravel this mystery. You see, the best strategies in the financial realm are often shrouded in simplicity. This revelation is based on a profound study by Meb Faber in 2013, and has been a cornerstone for financial juggernauts like billionaire trader Paul Tudor Jones. If you're here to enrich your financial understanding, you're in the right place. The essence of the strategy. Our discussion revolves around the prominent 500 companies in the U.S. Liquidity and scalability, not an issue. At the heart of this strategy lie two foundational rules, with the first being the 200-day moving average rule. This rule is straightforward. Purchase the S&P 500 index when its price surges above the 200-day moving average and divest when it plummets below. Simple, right? However, the true beauty lies in the results. The equity graph, starting from 1960, showcases an upward trajectory, effectively bypassing major market crashes like the harrowing 2008 financial crisis. A deep dive into the strategy. Curious about the 200-day moving average during 2008's crash? The average price of the S&P 500 for the prior 200 days, represented by a crimson line, showcases the market's volatility during that tumultuous time. By sticking to our strategy, the major blows would have been evaded. But can this strategy be enhanced further? Indeed. Let's consider a different angle, replacing the 200-day moving average with the 10-month one. A comparison of both strategies paints an intriguing picture, with the 10-month average edging slightly ahead in consistency. The prowess of the 10-month rule becomes evident when juxtaposed with a traditional buy-and-hold approach. An initial $100 investment in 1900 under the 10-month rule would metamorphose into over $5 million, outshining the buy-and-hold tactic. The resilience through turbulent times. From the 1931 market dip of 43% to the 1973 15% loss, the market has seen its fair share of tumultuous periods. However, with the 10-month rule under our belt, these declines would have barely grazed our portfolios. Fast forward to the 2022 pandemic, the S&P 500's peak in February was quickly followed by a steep decline in March. Adhering to our 10-month rule, you would have safely exited before the steepest drop and re-entered when the situation stabilized. Wondering about individual stocks? Let's peek at Cathie Wood's renowned ARK Innovation. Or how about Amazon under Jeff Bezos' leadership? Their trajectories, when mapped with the 10-month rule, signify the potential for substantial profits while sidestepping significant losses. Expanding the horizon, global application. While the focus of this strategy has been primarily on the S&P 500, representing the top tier of the American economy, its applicability is universal. How might this strategy fare when superimposed on other global markets? Taking the Nikkei 225, for instance, which is a barometer of Japan's economic health, or the FTSE 100, reflecting the UK's business pulse, our preliminary findings suggest a similar pattern of profitability. By applying the 10-month rule to these indices, investors could have navigated the Asian financial crisis of the late 1990s or the Brexit uncertainty with much more aplomb. The logic behind the magic. You may be wondering, what's the rationale behind the efficacy of this approach? The underpinning philosophy is trend following. Financial markets, driven by collective human behavior, often move in discernible trends, be they bullish or bearish. The moving average, by virtue of its design, helps to smooth out short-term fluctuations and identifies these broader trends. While no strategy is immune to false signals or whipsaws, short-lived breaks above or below the average that don't materialize into longer-term trends. The 10-month rule ensures we stay aligned with the prevailing trend, limiting our exposure during pronounced downturns. Diversification and risk management. Of paramount importance in any financial strategy is the concept of diversification. The moving average approach doesn't imply putting all your eggs in one basket. Diversifying across various asset classes, sectors, and geographies is still a cardinal rule. When you combine this strategy with diversified holdings, it provides an added layer of protection, ensuring one misstep doesn't spell disaster for the entire portfolio. Moreover, it's crucial to reiterate that no single strategy, however historically robust, guarantees future results. The market's evolution, changing global dynamics, and unforeseen black swan events might present challenges. However, the moving average approach offers a tool, one among many, to mitigate risks and optimize returns. The road ahead. While technology and algorithms are increasingly dominating the world of finance, the principles of sound investment and risk management remain unchanged. The moving average strategy harks back to these foundational principles, offering a disciplined, systematic approach in a world often swayed by emotion and speculation. Our journey into the world of finance and investment strategies will continue, exploring newer avenues, debunking myths, and empowering you, our financial literacy family, with the knowledge to make informed decisions. Harnessing the power of technology. In this era of rapid technological advancement, financial strategies like the moving average are greatly enhanced by tools and software that streamline data analysis. Automated trading platforms, driven by advanced algorithms, now facilitate the process of tracking the 10-month rule, ensuring that investors can act quickly based on real-time data. This intersection of finance and technology, known as fintech, has democratized access to strategies that were once exclusive to financial elites. Adapting to market dynamics. As we traverse this journey of financial enlightenment, it's paramount to remain adaptable. The market is a living entity, continually evolving, shaped by both macroeconomic factors and human sentiments. The beauty of the moving average strategy is its inherent adaptability. By adjusting the parameters or even combining it with other strategies, it can be fine-tuned to resonate with one's unique investment philosophy and risk tolerance. Continuous learning, the real asset. The world of finance is expansive, with a multitude of strategies, each having its strengths and limitations. This moving average technique, though robust, is just a fragment of the bigger picture. Financial literacy is not about mastering one strategy, but about continuously exploring, learning, and adapting. By staying curious and open-minded, we equip ourselves to navigate the complexities of the financial world more adeptly. Engage and share your insights. Our financial literacy community thrives on active participation. How has the moving average strategy worked for you? Are there modifications you've made to suit your investment profile? Share your stories and insights in the comments below. Your experiences could illuminate the path for fellow investors, fostering a spirit of collective growth. Together, towards financial freedom. Our mission at Financial Literacy is not just to impart knowledge, but to nurture a community where each member uplifts the other. By sharing insights, debating strategies, and celebrating successes, we aim to create a cohesive ecosystem where financial empowerment becomes a shared goal. Concluding thoughts. The financial markets landscape continually oscillates, yet some strategies remain timeless. This moving average strategy is a testament to that, providing a mechanical, emotion-free roadmap that safeguards against volatile downturns and capitalizes on growth periods. With over a century of consistent results, it could be a game changer for both budding and seasoned investors. If this deep dive enlightened your financial acumen, do us a favor. Click that like button and don't forget to subscribe to Financial Literacy for more data-driven insights. Let's elevate our financial intelligence together